It's time now for the big picture. Let's welcome in Joe Mazzola, head trading derivatives strategist at Charles Schwab. So it looked like earlier this morning we were back to those levels that we were at before the Friday sell-off. We've just ducked below 700 now on the S&P 500. But what's your steer on everything this morning? Good morning to you, Joe.
Yeah, it's interesting how the markets are reacting more to the AI, I think, than they are to the threat of the U.S.-China trade war. Taiwan Semi delivered, I think what the market needed. And that's just some proof that the demand for advanced chips isn't just merely kind of the speculative fervor. I think that, their blowout quarter basically is kind of setting the tone and maybe raising the bar for other technology stocks, especially those with either AI or AI adjacent plays. And so, that I think that's what investors needed to hear. Look, Sam, we've also gotten strong earnings out of financials as well. I think that was expected, but I think the TSM earnings was a nice shot in the arm.
Yeah, no doubt about it. In fact, I actually heard someone say this morning that they thought even what TSM had reported was kind of conservative when they talked about the outlook, given the AI hype. But we're also seeing, some nice rallies in some of the memory chip names, as well as we're seeing very much the spending leading to sort of tighter supply there for, the more conventional stuff too. So, yeah, it seems like an overall sort of AI theme here. Can that continue to push things higher, do you think? Because, we've just seen how vulnerable and sensitive the markets are to this trade war.
Well, I think what was difficult is Friday did some damage to market breadth. It's slowly coming back, but it's one of these things where if it's a very small segment of the market that's doing the majority of the heavy lifting, then when you get, when those couple of those stocks get taken out, like we saw on Friday, that hurts. And it was something that pulled down the market 2.5% on Friday. But, we're slowly coming back. I think right now, percentages of stocks above the 50 is right around 50%. And then above the 200-day moving average is around 61%. So, I wouldn't call it exceedingly healthy, but I would say at least it's putting in a little bit of a floor. What's interesting, though, Sam, is when you look at the sectors that have the most concentration or, percentages of their stocks above the 50-day moving average, it's not what you would think would be the leaders at this point. It's utilities, it's healthcare. Technology is kind of creeping up above a little bit, but it's barely showing more than 50% of its stocks above the 50-day moving average. So it's not a market that's lifting all ships. It's something where you're seeing some speculative areas in some of the technology names. Just a perfect example of that would be the difference between a VIX that's trading over 20. And then what we're looking at with the equity call option skew, which is definitely pointing towards retail buying a lot of the upside calls in some of these tech names. So a little bit of a dichotomy there between what you're seeing on the institutional side and then on the retail side.
Yeah, and it's also interesting when you look at sort of the software semi-spread as well. If you take a look at some of the names across the space over the last week or so, that's not a new trend, but it certainly seems to be sort of widening the gap, you could say. Tell us as far as what you're seeing with the technicals. You mentioned, this rotation at least that we've seen in utilities, no doubt catching a bid off the back of an extension of the whole AI trade, healthcare also doing quite well. What do you put this all down to as far as this sort of rotation that we're seeing? A lot into sort of value out of momentum earlier this week. Then we saw a bit of an everything rally. But what stands out to you?
Well, looking at the technicals right now, we're right at that 20-day moving average. So this was an area that up until Friday and Monday, we really hadn't had 2 days below that 20-day moving average going all the way back to April. So we did get below that. It could be some area of resistance right here. It could be an area of a little bit of consolidation. I think the 50-day provided some support. That's right around 65.50. And if you kind of look at the way that optionality is kind of set up right now, I think that 65.50 is a pretty important level. Anything below that, you're going to start to see maybe some negative gamma flow, which is going to cause the dealers in the market makers have to sell some futures against that. They could push it a bit lower. I think where we're at right now, you're kind of at a little bit of an equilibrium. And when you were talking about the sector rotation, it's just kind of interesting. rewinding back to last week when we were talking about everything rally and then, kind of hit the skids on Friday, it's still a market that is sensitive to news and the changing news. And when we got a catalyst like we did on Friday, that kind of maybe rocked the boat a little bit. I think a lot of people were kind of caught off guard. I think a lot of that sell-off had to do with some of the short volatility plays that were out there. So, a lot of things lined up all at once to kind of exacerbate that move.
Right, and also because of the fact that there are so many views out there that this market is just priced to perfection, which very much, speaks to some of the vulnerabilities out there as well. Joe, always a pleasure. Thank you so much for joining me this morning. Joe Mazzola there, head trading derivatives strategist over at Charles Schwab. Appreciate your time.